What if I told you that a single decision made behind closed doors in Threadneedle Street could ripple through global markets, rock your mortgage payments, and shift geopolitical balances? In the coming minutes, you're going to see how the Bank of England's latest move not only shapes Britain's economic destiny, but also sends shockwaves into international capital flows and power dynamics. In May 2025, the Bank of England cut its base rate from 4.50% to 4.25%, marking the second such reduction this year. Many analysts now expect further cuts over the remainder of the year. But don't let the simplicity of that headline fool you. Beneath it lies a tangled web of inflation battles, household stress, investor reshuffling, and even geopolitical ripple effects. Let's start with why this matters, and how a central bank's internal calculus becomes everyone's business. Britain has long wrestled with inflation. In March 2025, the Consumer Price Index, CPI, stood at 2.6%, down from prior peaks but still above the bank's 2% target. That gap, small as it may appear, torments central bankers. Hold rates high, and growth chokes. Drop them, and inflation re-accelerates. In this tension, the BO has opted for cautious maneuver. Andrew Bailey, the governor, advocates incremental easing rather than dramatic shifts. But global pressure compounds the complexity. US trade policies, tariffs, and supply chain dislocations create a volatile backdrop in which British monetary policy cannot act in isolation. Here's where the domestic stakes loom large. Roughly 1/3 of UK households carry a mortgage, and about 600,000 borrowers hold floating or tracker mortgages directly tied to the bank's rate. With the 0.25% cut, some of those borrowers see their monthly repayments fall by roughly £29, a relief, but small in the broad scheme. Yet many mortgage holders are locked into fixed-rate contracts. Their payments won't change immediately, but when their fixed term ends, they'll face fresh, and often much higher, offers. The upshot? A wave of refinancing pain expected through 2027. Meanwhile, new mortgage deals carry eye-watering rates, a 2-year fix averaging 5.14%, a 5-year fix at 5.08%. That's a very different world from the sub-3% fixes of earlier years. The cost of borrowing is punishing. Beyond housing, the rate cut bleeds outward. Business loans, credit cards, auto finance, all edges are pricked. Banks may respond by lowering their own lending rates, but they do so at their own pace. On the flip side, savers take the hit. The average yield on easy access deposit accounts hovers near 3%, and could dip as rates fall. For pensioners or income-reliant individuals, that matters. It's money that vanishes slowly, yet quietly, from your returns. So, the rate cut eases pressure on borrowers, but tightens it on savers. It's a redistribution, a carve-out of constraints to push growth, yet it comes with trade-offs. Now zoom out. What does Britain's rate trajectory tell us about global capital? When a major central bank eases, capital flows recalibrate. Yield-chasing funds may shift from UK sovereigns to higher-yielding assets abroad. Sterling might weaken, inflation import costs may rise, and foreign investors will watch all this like hawks. The UK competes for capital not only with the US and Eurozone, but increasingly with emerging markets. And here's the geopolitical dimension: central banks are not neutral. Their decisions ripple into trade, credit, and influence. A weaker pound aids exports, but stokes inflation in the raw materials you import. A more nimble UK borrowing cost helps government spending on defence or diplomacy. The monetary margin is becoming a soft lever of statecraft. For investors and policymakers alike, this interplay is a warning. Monetary policy is now integral to strategic posture, not just economics. By the way, if you've found these insights useful so far, let me ask you this: do you think the Bank of England should keep cutting rates, or hold steady to avoid inflation risks? Drop your thoughts below. I'd love to hear your perspective. Returning to 2025, markets now price in further cuts, perhaps toward 3.5% at the deeper end. Yet there's a catch: the bow must guard against oversteering. Too much easing could rekindle inflation. Too little could smother growth. It's a tug of war. The bank's challenge is amplified by external headwinds. Global supply shocks, trade tensions, and currency swings all complicate the road ahead. And domestic political winds add pressure. Any incoming government will face demands, from voters, from Westminster, from markets, to deliver stability, jobs, and growth. Monetary policy becomes part of the political toolkit, not a technocratic seclusion. What should investors, citizens, and watchers be on the lookout for? Inflation signals: a rebound could force rate holds or reversals. Mortgage resets: as fixed deals expire, a new borrowing shock could ripple across consumption. Capital flows: watch sovereign bond yields, foreign investment trends, and currency pressures. Fiscal monetary alignment: will new spending plans support or strain the bow's path? International comparators: what the Federal Reserve or ECB do will matter. They may force British responses. Because the real story here isn't just that rates fell by 1/4 of a point. It's that we are entering a delicate balancing act, one where central bank decisions, once arcane and technocratic, now sit front and center in the daily lives of households, firms, and nations. In a volatile world, the difference between a 4.25% rate and a 3.5% rate isn't just decimal arithmetic. It may feed into national trajectories. Now I want to know what you think. Will the Bank of England push rates below 4% this year, or is the risk of runaway inflation too high? Share your predictions in the comments, and while you're here, don't forget to subscribe for more deep dives into the crossroads of geopolitics and the global economy. Thanks for watching.